Welcome to Between Two Chairs, Demystifying Commercial Real Estate, the podcast that brings you the latest insights and trends on the South Florida commercial real estate market, with your hosts, Fernando Arencibia Jr. and Jennifer Woolman. In each episode, we dive into the world of commercial real estate and break down complex concepts to make them accessible for everyone. Whether you're a real estate professional, a curious investor, or just interested in the South Florida market in general, Between Two Chairs is the podcast for you. So pull up a chair and join us.
Welcome, everybody, to another episode of Between Two Chairs. My name is Fernando Arencibia Jr., and with me, as always, is the very educational, very teacher-like Jennifer Woolman. Jennifer, say hi.
Hi. That doesn't sound very teacher-like. Hello, my name is Miss Woolman. You may call me Miss Woolman. Mrs.
I love it. Mrs. All right, Mrs. W., what are we going to be chatting about today?
So you just got back from Washington, D.C., where you attended a bunch of National Association of Realtors, not only the business meetings, but there were also some legislative meetings with our local legislators. So thought maybe you could give us an update.
Yeah, no, absolutely. These meetings are very valuable because they serve really three purposes. One of them is to update everyone who shows up on the market. There's always a great presentation by Dr. Lawrence Yoon, Chief Economist for NAR, on the residential market and on the commercial market. It's always extremely thorough. Secondly, it's where we have our mid-year meetings, where all of the committees, whether they're involved in advocacy or not, they meet to do the work of the association and on behalf of the membership. And the third, and probably the most important, is we get to actually advocate on behalf of the things that are important to our industry and to the people that serve within the industry. And that's when we get to go to these Hill visits and meet with our representatives from the House of Representatives and our state senators, as well as, so imagine, thousands and thousands of realtors pretty much landing in D.C. and having these meetings over the course of a few days. I thought it was interesting to start by just relaying some of the data that has been shared. Here are some highlights or some quick facts that I thought would be interesting. One is things that we've discussed in the past, which is that we are historically below average in the level of housing construction in our country. And this has been a thing where for the last 14 years, we have been underproducing the number of housing units that really we need. Our country still lacks about 4.7 million homes. And this is an important point because it speaks to supply and demand. And it speaks to the question that is on everybody's mind, which is, will there be a correction in our market? Is there going to be some shift? Are there some changes that are coming? And I always say, and you always say as well, that we got to look at the fundamentals, the economic fundamentals of the country, the economic fundamentals of our state and the local area that we serve. Middle income buyers are feeling an inventory shortage, that's for sure, even though we've seen more inventory come into the marketplace. It is estimated that there's about 420,000 listings in the price range of 260,000 and below that is missing. So there's like a missing middle market that is underserved in most of America, including here in South Florida. Homeownership is something that is talked about a lot. And there was some data that was shared that homeowners have 40 times the net worth of renters. There's something valuable about, racking up your home equity, and that represents over 60% of households' net worth is between home equity and retirement accounts.
And an interesting podcast, an episode of the Trepwire podcast that was done recently stated that we're starting to see homeowners tapping into that equity.
Correct.
So that's something to look for. Are they tapping into that equity to pay off the credit card debt, which is now also at an extremely high level? Or are they tapping into their equity to take advantage of opportunities that they see in the market?
Correct. Yeah, and one of the things that was presented to us is really there has been an incredible price appreciation in home equity shares over the last 5 years. And in the state of Florida, on average, that accounts for about a 68.7%, almost a 69% increase in equity in properties, which is why the typical homeowner nowadays has accumulated over $195,000 in wealth due to price appreciation. Real estate is an important sector, in our economy, is an important sector overall, represents 18.3% of total U.S. GDP, and each home sale produces about $125,000 in local economic activity, and it generates at least 2 jobs. Again, talking about the impact of the industry. In 2024, local and state governments collected more than $797 billion in property tax revenue. They accounted for 38% of the total state and local tax receipts. And, of course, we are the National Association of Realtors when we're there together. So we look at what is the impact of the real estate professionals. Well, 88% of realtors are independent contractors at firms. 65% of those are women, using their professional expertise to help consumers navigate the intricacies of real estate transactions. And that would be the end of my pitch. But as you can imagine, the beginning of this meeting has to do with giving an update as to what is happening in the Hill and what are the things that are important to discuss. And of course, the entire conversation is about the tax bill, the extension of the Tax Cuts and Jobs Act, dubbed the Big Beautiful Bill. And so a big part of the conversation is really that both the House and the Senate have a version, and now they're going to go into something called reconciliation. And this is where really the negotiating is happening. There's a lot of stuff in the bill that are things that are positive for real estate overall and things that are supportive. And I think the counterbalance to that is the concern about the mounting debt that the country is amassing and what kind of negative effect that might have on the economy. It looks like there was a desire to make this happen, this reconciliation, by July 4th. That might be too much of an aggressive, timeline. But it certainly feels that by August we'll have some resolution as to what the tax bill is going to look like.
So what are some of the commercial priorities that came up, or because you're also on the commercial committee, what are some of the discussions? What are people seeing in their markets? What's great about these meetings is because you're meeting with commercial brokers from all over the country, you get to share information about different markets, because sometimes what we're seeing and experiencing on a local level is completely different from other areas, even areas that might be within our same state.
No, absolutely. I have the honor of chairing the Commercial Federal Policy Committee. We have great experienced commercial brokers from all around the country. One of the things that we did was we did a survey, and we actually did a live survey. So within the meeting, everybody connected via a QR code, and we basically had 14 questions that had to deal with the marketplace. And it was very interesting. There are some things that are universal. At the top of the list of concerns is insurance cost. And insurance cost and sustainability, those factors are paramount because a lot of the deals all around the country are not penciling out because of the cost of insurance. So that seems to be a recurring conversation. There also seems to be very specific conversation about tort reform as a way to curb some of the insurance issues that people are facing around the country, including in California. I met someone from California that those are the kind of conversations they're having, which reminded me of some of the conversations that we've been having in Florida before the one-way attorney fees was repealed a few years back.
Right. We've seen that the tort reform that we implemented, what was it, 3 years, 4 years
three
ago
years,
now?
3 years ago or so.
Is now we're starting to see that effect in a positive way on insurance prices and more insurers coming into the market.
Yeah, correct. Certainly there are some markets that are feeling the effects of the tariffs. They're very concerned about where those tariffs are going to settle. And there was a lot of reporting of deals that were kind of delayed, if not dead, as a result of all of the uncertainty that is happening. Overall, I think that there is a sense by commercial brokers based on that exercise that we did that there is a positive light at the end of the tunnel, that however the tax bill settles, that having clarity as to what's going to happen, it's going to be important, and that ultimately they feel positive about what happens at the end of the third quarter, the beginning of the fourth quarter, when things kind of settle down. Meanwhile, all the deals are taking a lot of work to put together, and I think overall everybody's feeling the effects of the uncertainty in the marketplace. And even though everybody's kind of navigating it and finding a path forward, everybody feels that the deals are a bit complicated, but nothing that they cannot overcome. It's just taking a little longer. It's just you have to work harder, and and those things. What I did find really interesting and very rewarding, if I may say this, is part of the work that we did with this committee at the end of last year is we created a work group between the Commercial Federal Policy Committee and the the Federal Taxation Committee. And in that work, we reviewed every single policy. There's 119 different policy statements or positions taken by NAR over the course of its entire life, right? And out of those 119, there were like 47 that were specific to this issue of commercial development and taxation. And one of the things that came out of those meetings is 2 motions to update our position on basically the demise of older buildings and the redevelopment of those buildings. So there were 2 motions that were proposed, and one of the motions was to reaffirm, strengthen, and modernize its support for tax policies that incentivize the voluntary demolition of obsolete structures by allowing, at the election of the taxpayer owning the land and the demolished building, the cost of demolition to be either expensed in the year of demolition or to be added to the basis of any new building constructed upon the land previously occupied by the raised building. So this is important in the sense that up to now, when you raise a building, right, when you demise the building, that gets added to the basis, but you can't just expense it out in the year of the demolition. So all of those costs, you don't have that option currently in the tax code. So this is one of the motions that was proposed, and it successfully passed, which means that now it gives the opportunity for all of the people that work within the organization that are advocating on our behalf in the Hill to advocate for these changes in the tax policy. And it will be part of the conversation, even with this big, beautiful bill, because it gives the people that work for the organization the ability to say this is expressly a position that the National Association of Realtors has taken.
And I would think there'd be some other associations like the National Home Builders Association, the Builders Association, that would support it for sure.
Yeah, the other one has to do with the rehabilitation of older commercial structures. And listen, we've had a lot of conversations about this, and part of the conversation has to do with everyone who has looked at converting older office buildings, and the office issue in many parts of the country, in many markets, is significantly dire and difficult, even though it is getting better because nationwide we're starting to see a positive absorption of office that we haven't seen in the last 5 years. If you're looking at it nationwide, in Miami, we're spoiled from the fact that we have the number 1 office market in the country. So we are not seeing the same effects, even though you and I have often spoke that Class C buildings are not performing as well as Class A and Class B because of, a flight to quality and all those things that we have mentioned. But one of the other motions which also passed and is supported is about creating more incentives for you to rehabilitate older commercial structures, including tax credits, exclusions, deductions for the cost of modernizing, adapting, or converting the structure to a new use or uses. And in the case of, say, historically significant buildings, for substantially restoring the structure to its original condition, notwithstanding the fact that the use of the building might be different, but you're still maintaining the historical integrity of the building, for example. We felt that this was not a policy that was very clear at NAR, and we wanted to provide clarity to give, again, those that are advocating on our behalf the ability to advocate and to have clarity as to what it is that we're looking for. we mentioned, I think this is a good time to mention that. So this is an article that Robert Palacios, who was last year's CCIM president for the Miami-Dade chapter, who's a great, commercial broker and good colleague of ours. He sent me this article about Boston, and I shared it with the committee, and we had a conversation. And basically, the city of Boston lost a huge amount of tax revenue because of the amount of office buildings that are vacant. And what happens is that as a result of that vacancy, then the valuation of those buildings gets reassessed. And out of that reassessment, now those buildings are going to pay less in taxes. Well, there was one example in the article that was very glaring, and I think it was called One Lincoln. And basically, it was this 1.1 million square foot office, complex that was sold in distress for $400 million, where it had a loan for $1 billion. So that just tells you how precipitous the devaluation.
$600 million haircut.
Yeah, it's unbelievable. So as a city, now you lose all that, all the revenue of that valuation, and they're basically having to make up $1 billion. And according to the article, that is getting passed on to the homeowners, who are seeing 9 to 10% to even 12% increases in their tax bill, in their property taxes, to make up for that difference. And it looks like it's something that they're going to have to deal with for the next 5 years. So for me, the reason why that article was so important is because not only does it bring up a big issue within that municipality, but it also tells you that this is really not providing incentives for the conversion of these buildings. It's not an issue that only affects the developer. It's only about that side of the aisle, but it becomes an apple pie issue when now a city has to make up the difference by having to tax its homeowners.
Yeah.
Right. And so definitely making sure that there is a pathway through the tax code to incentivize that kind of work. And look, it may not fully work, but unless we have some sort of additional incentive, those deals are definitely not penciling out.
Right. Well, in terms of that, my first reaction is, okay, there's some buildings that I wouldn't want those tax things going to, because just of functional obsolescence, no matter what you do, it's land value, tear it down, start new, right? And that's going to increase your valuation. But to your point, and to your point about the numbers having to make sense for an area as well, I was I've heard a couple of different podcasts or read articles that have been focusing on fractional ownership or fractional usage. So whether it's like the extended stay hotels or the WeWork type office buildings, that it's time to start reconsidering how we use our space, since now people are so much more transient, right? If you can work from anywhere, you can live anywhere, you can, so maybe you don't have 5 to 10 year office leases, so that's why WeWork now is restructuring, and they're admitting that they are a real estate company, not a tech company. And their new CEO has said, let's embrace it. Let's embrace this use. Let's realize that there are a lot of multinational companies that have seen the need over the last several decades between COVID and the great financial crisis and everything else, where you don't want to be tied into a 10-year lease, where then it's costing you a lot of money to get out or to continue to pay. So I think, again, to me, in terms of connecting the dots and seeing different types of usage for what has historically been, let's say, a hotel, right? Now they're saying, no, we're seeing people coming and staying with us as an alternative to renting an apartment for a year, or as an alternative to an Airbnb. So I think that that's something really interesting, too, to be considered, to really start thinking, if you have these buildings with vacancies, what could another use be? Or could you be doing pop-up retail if you're in a market where the retail space just isn't moving, which, again, doesn't happen to be Miami, but there are pockets that might have higher vacancy rates. So anyway, I think it's a very interesting time to start thinking outside the box and getting creative with how you imagine spaces to be. And anyway, what else came up? I digress.
Yeah,
as usual.
No. Listen, all fair points. And I'll just add another part of, there's been things that we have been advocating for. We have a huge amount of property owners that normally, if you were to follow historical cycles, would have by now listed their property for sale. And they have been hesitant to do so for a variety of reasons. Some because they are locked into a great interest rate, and some because they are looking at their tax liability because of the equity going up. So something that we've been advocating for the last couple of years has been to double the exemption primary property owners when they sell their home. So currently, if you're a single person and you own your home and it's your primary residence and you sell it, you can exempt of up to $250,000 in profit, right, on the sale of the property.
If you're single,
if you're married, right, that number is
$500,000.
So that is a number that really hasn't changed since the late 80s, right? And so the idea is to double that number, make it $500,000 for single, make it $1 million for married couples, and to then tie it to an index so that as CPI moves, as inflation moves, then that number would also move with it, and it would adjust, and you wouldn't have to touch it again in the future and having to go back and advocate for it again. And then everything else really had to deal with the revitalization of areas where you are encouraging, development and boosting housing productions, right? And that's really the key here is how do we remove the barriers to entry to make sure that we are able to make up that 4.7 million housing shortage that we have in America after spending 14 years underbuilding. If you go all the way back to the time of the Great Recession, we kind of stopped building and we've never really ramped up to the levels that we need. You and I have always discussed that Steve Levy mentions, which is that this is, the real estate business is a demographic and a labor market business. And at the end of the day, the population growth is here to stay, and those people need housing. So the need is continually going to be there.
Well, and I think the interesting thing that all of this brings up, and it's where the fun part of the conversation starts, is so with all of these tax incentives that we're looking for, that increases the national debt, right? So what do you use to offset those increases? And does the money that's going to be generated, is it going to make up enough to more than offset? Because it not only has to offset its own cost, it has to help, cut some of the existing. And in terms of housing, a lot of what we're building, I keep arguing, isn't what people want. We're building, building apartment buildings for rent. And people don't want to live in rentals. The majority of the people want to buy. They want to own something, and we can see why based on your numbers. And it behooves us as a country to be building that, because if we're building up the wealth of our citizens while at the same time creating much more stable communities, because people tend to stay longer where they own, they tend to invest more time and financial resources and volunteer more in an area where they're planning on being for a while, then to me, that's where we should be spending the efforts. How do we make building single family homes or condos?
The great late Mo Vesey, he was a great orator. He used to be president of the National Association of Realtors from Miami, and a heck of a commercial agent as well, and someone that we love dearly. And he used to always speak about the social benefits of home ownership. And it's very important that for a democratic republic like ours, the health of the middle class is very important to the health of our republic. And when you look at all of the social benefits of home ownership, it's not only the equity, the fact that you have a higher net worth, it forces you to save, right? Just because you're paying your mortgage and the equity is going up, and you're saving from that angle of that property is significantly higher than the rate of savings that you do when you put money in the bank. But there are also incredible social benefits to your children of homeowners. There are so many things, and I'm sorry that I don't have all of that information readily available, but I will tell you that if you research it up, you'll see that there is an incredible amount of social benefits to our society overall, to encouraging and helping people achieve home ownership, right? And it's a big part of our work. But to your point about what's being debated in the Hill today, it is a balancing act because, you also don't want to have an economy where the rate of debt is increasing so significantly that then whatever it is that you're doing to incentivize short term might come back to bite you in the long term. And so I think that that's part of the conversations that are being had overall because, you can grow your GDP. That's one way to do it, but that's not something that is as straightforward as people make it out to be. So those things are important. I would say that, as I mentioned, there was a presentation on where we are on the commercial sector. All the numbers are trending positive. And there was obviously a lot of conversation about inflation and about the Fed rate cut and also about, what has been historically an inflationary, activity. And, Lawrence June did a great job of kind of breaking down the idea that, the Fed rate cuts are going to happen once inflation is under control. The April number was at 2.3. They wanted to be at 2 or below. And it definitely is obvious that the Fed is going to be very conservative. But he was looking at, there were things that prior were inflationary, and now there are things that are disinflationary. And you made a good point today to say that doesn't mean that prices go down. It just means that it doesn't create more inflation, right? And so the tariffs are an inflationary force. But then when you look at shelter costs, those are going down. And that basically is the cost of everything to keep a roof over your head, right? Deregulation is a disinflationary force. Oil prices are under control. The reciprocal tariff to zero is disinflationary. When the economy is a bit weaker, and there was discussion that the original expectation for our GDP was that there would be a 2.1% growth. Now that has been adjusted to 1.7. It might be adjusted further more. But when the economy is not all ramping up, in all cylinders, that's also a disinflationary force. The weakening of the dollar is inflationary. But again, the cost of pharmaceutical drugs, which is another metric that they look at, is disinflationary. So there's more things that are going to kind of balance out any other inflationary forces than there are inflationary forces. So the expectation is that we will see a change in the Fed rate cut, right? We are expecting for it to be there, but I don't think anybody is expecting for rates to be any lower than 6.25, 6.3 when it comes to financing a home, for example. I think the mid to lower sixes is where the target is for 2025, right? It might be like that for the beginning of 2024, but there was it. I mean, 26. Forward. Yeah, we're moving forward, not backwards. So on an overall commercial market forecast, Lawrence spoke about job growth continuing, which is a boost to demand. There is positive net absorption, so there's going to be more leasing, and they're seeing it in office, which I thought was a great thing. I'll mention that because I think it's a good stat to look at. So the absorption of office, right, over the last 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 out of the last 10 quarters, we've seen a negative absorption of office, right? So, for example, quarter 4 of 2023, 63 million square feet of office space that was basically not being absorbed. So those are, tenants move out, nobody's moving in. And so you have a negative net absorption rate. Well, for the first time in quarter 1 of 2025, you have a positive 2.5 million of square feet that are being absorbed. So of course we got a long way to go, but it just feels like the bleeding has stopped. The other things that he mentioned is that the rents are rising, but comparative to CPI, so they're not way above. They're not going crazy. I think in office nationwide, he mentioned that we're seeing a modest 1.2% increase. In other markets like Miami, of course, that number is different. Vacancy rates seem to be peaking. Something that I think anyone who is a commercial broker that listens to this may find interesting. You may be having conversations with people that are saying about oversupply of multifamily and industrial. And when you look at the numbers, that is going to be a very temporary scenario. Just because there's a nationwide, there are a lot of deliveries for multifamily, new development, and industrial that has come into the marketplace. So that kind of tweaks the vacancy rates as those things get absorbed. But the feeling is that it's going to be very, very short term. In fact, one of the things that they mention is they're expecting the numbers in 2025 to be very different in 2026, just because those properties are going to get absorbed this year, but next year we're not going to have anything new coming along. Mm-hmm. Those things are important. And then, the permanent oversupply in office, which is why we talked about providing tax incentives in the tax code to address these things. But overall, definitely the outlook is, we understand that there is uncertainty. The market is more sticky, and let's just say that it's going to take more work to get these transactions done. But transactions are still happening, and there is a light at the end here where there's going to be more clarity and more understanding. And it seems to me also that everybody that was speaking, whether in the panels or in a presentation, that they were expecting that this year was going to be like that, first year of a president, they're trying to get a lot of big things happening. And so, of course, there's going to be a lot of moving part. It does lend itself to uncertainty. And I think dealing with this tax cut bill, the permanency of the Tax Cuts and Jobs Act and finalizing it is going to go a long way to kind of settling the markets. Other than that, I really miss you. You were not around to help me out, guide me through life.
You have enough handlers nowadays.
No, I don't have any handlers. I can barely handle myself. So, so anyway, guys, thank you so much for joining us on this episode of Between Two Chairs. I hope you find it valuable. There's a lot of good stuff, a lot of good work. I'm very proud of the two motions that now they get to advocate for these things. Let's see what kind of results come out of there, but it was a really positive experience, and I'm glad that I'm glad that we're trucking along and moving forward and trying to do good things.
Until next time, everybody. Bye-bye. Say bye, Fernando.
I love it. Bye, Jennifer.